Investing in solid income-producing assets is the only way an investor can assure their ROIs. Through diligent investing into companies that provide steady flows of income year after year can be one of the safest bets an investor can make in securing their money while realizing capital gains and making dividend passive income along the way. In this video, I'll discuss the Dividend Kings, what are they, and how you too can invest into companies that are guaranteed to grow over time, providing handsome returns on your investment while paying you growing passive dividend income like clockwork. By following the easy steps outlined in this video, you too can grow your investments over time in a systematic fashion, substantially increasing your wealth during the process. Get ready, you are now entering the Academy. Dividend Kings are S&P 500 companies who have increased their dividend for 50 plus consecutive years. This is an amazing record of consistency. That is why there are only 29 companies that qualify for the Dividend Kings list. These companies have survived and prospered through the best and worst of times. Investing in companies that have been able to move forward through all types of environments and economic cycles is one of the wisest decisions a savvy investor can make. Let's look at a breakdown of who the Dividend Kings are. The following is a list of Dividend Kings broken down by industrial sectors. Basic materials, we have Stepan, ticker symbol SCL. Consumer cyclical, we have Genuine Parts Company, ticker symbol GPC, and Lowe's Company, ticker symbol LOW. In consumer defensive, we have Colgate, ticker symbol CL, Hormel Foods, ticker symbol HRL, Coca-Cola, ticker symbol KO, Lancaster Colony, ticker symbol LANC, Altria Group, ticker symbol MO, Procter & Gamble, ticker symbol PG, Tootsie Roll, ticker symbol TR, and Cisco Corporation, ticker symbol SYI. In financial services, we have Cincinnati Financial, ticker symbol CINF, Farmers and Merchants Bancorp, ticker symbol FMCB, and Commerce Bank Shares, ticker symbol CBSH. Healthcare, we have Johnson & Johnson, ticker symbol J&J. Industrial, we have ABM Industries, ticker symbol ABM, Dover Corporation, ticker symbol DOV, Emerson Electric, ticker symbol EMR, 3M, ticker symbol MMM, Nordson, ticker symbol NDSM, Parker Hannifin, ticker symbol PH, and Stanley Black & Decker, ticker symbol SWK. Real estate, we have Federal Realty Investment Trust, ticker symbol FRT. Utilities, we have American States Water, ticker symbol AWR, California Water Service, ticker symbol CWT, Northwest Natural Gas, ticker symbol NWN, SJW Group, ticker symbol SJW, Black Hills Corporation, ticker symbol BKH, Universal Corporation, ticker symbol UVV, and National Fuel Gas, ticker symbol NFG. The Dividend Kings are overweight in the industrials, consumer defensive, and utility sectors. Interestingly, the Dividend Kings have no exposure to the technology sector, which is the largest component of the S&P 500 index. The Dividend Kings also have some interesting characteristics with respect to market capitalization. They consist of 3 mega caps, over $200 billion in market cap, which are Johnson & Johnson, Procter & Gamble, and Coca-Cola. 12 large caps in the $10 billion to $200 billion market cap. 10 medium caps in the $2 billion to $10 billion market cap. And 2 small caps in the $300 million to $2 billion market cap. Interestingly, 15 of 25 Dividend Kings have market capitalization below $20 billion. This shows that corporate longevity doesn't have to be accompanied by massive corporate size. Stable dividend growers like the Dividend Kings tend to slightly underperform in bull markets and outperform on a relative basis during bear markets, making its 2020 to 2021 date performance even more impressive. But the performance of the Dividend Kings show that boring, established blue chip stocks that increase their dividend year after year can significantly outperform over long periods of time. And as can be seen by the following chart, Dividend Kings significantly outperform and provide a safety net during years of recessions, as can be seen in the dot-com bubble of 2002 and the financial crisis of 2008. Now I will discuss the top 5 Dividend Kings to invest in for 2021 and beyond. These stocks have both grown appreciation and sustained dividend growth that will continue through the foreseeable future, making these great investment vehicles for the savvy investor. To be able to increase dividends every year for decades, even during the deepest of business down cycles, a company must possess the following attributes. First, a sustainable and compelling business model. Second, a strong economic moat. Third, financial fortitude. Fourth, efficiency and capital allocation. Fifth, commitment to shareholders. And sixth, visionary management. And now we have the top 5 Dividend Kings. First is ABM Industries, ticker symbol ABM. ABM Industries is a leading provider of facility solutions, which includes janitorial, electrical and lighting, energy solutions, facilities engineering, HVAC and mechanical, landscape and turf, and parking. The company employs about 140,000 people in more than 350 offices throughout the United States and various international locations. ABM Industries reported its fourth quarter earnings results on December 16, 2020. Revenues totaled $1.48 billion during the quarter, down by 10% from the previous year's quarter. The revenue decline was primarily caused by lower demand from ABM Industries customers during the coronavirus crisis. ABM Industries generated earnings per share of 69 cents during the fourth quarter, which missed the analyst consensus marginally by 1 cent. Nevertheless, ABM Industries' earnings per share grew by 4.5% versus the previous year's quarter, a very solid growth rate when we account for the negative coronavirus impact on the company's top line. Shares trade for a P/E ratio of 15.8 compared with a fair value estimate of 17.5. An expanding valuation multiple could increase annual returns by 2.1% each year, plus expected EPS growth of 5% and the 2% dividend yield. Total returns are expected to reach 9.1% per year. Second, we have Lowe's Company. Lowe's Company is the second largest home improvement retailer in the U.S. after Home Depot. Lowe's operates nearly 2,000 home improvements and hardware stores in the United States and Canada. Lowe's reported third quarter results on November 18, 2020, and reported net earnings of $692 million compared to net earnings of $1 billion in the prior year period. Excluding a negative $1.05 impact from extinguishing debt, adjusted earnings per share increased 40% to $1.98 from $1.41 in the third quarter of 2019. Comparable sales increased 30% for the quarter. The key to Lowe's success over the course of 2020 has been its booming e-commerce platform. In the most recent quarter, Lowe's registered triple-digit online sales growth. This is a key differentiator between successful retailers like Lowe's and many other retailers that are reporting losses or going out of business. Lowe's is benefiting right alongside the e-commerce boom. Lowe's enjoys competitive advantages from scale and brand power as it operates in a duopoly with Home Depot. Neither of the two are expanding their store count significantly, and neither is interested in a price war. Both should remain highly profitable as the home improvement market in the U.S. is large enough for two companies to succeed. Based on expected EPS of $8.60 for the current fiscal year, Lowe's stock trades for a P/E ratio of 18.7. Our fair value estimate is a P/E of 20. The combination of its expanding valuation, EPS growth, and dividends lead to total expected returns of nearly 10% per year over the next 5 years. Third is Federal Realty, ticker symbol FRT. Federal Realty Investment Trust is a real estate investment trust or REIT. It concentrates in high-income, densely populated coastal markets in the U.S., allowing it to charge more per square foot than its competition. Federal Realty trades with a market capitalization of $6.7 billion. Federal Realty's business model is to own real estate properties that it rents to various tenants in the retail industry. This is a difficult time for retailers as competition is heating up from e-commerce players such as Amazon and many others. Mall traffic is declining, which has put pressure on many brick-and-mortar retailers. Conditions for retail real estate have become even more challenging due to the coronavirus, which has forced many stores to close. Federal Realty's competitive advantage include its superior development pipeline, its focus on high-income, high-density areas, and its decade of experience in running a real-world, world-class REIT. These qualities allow it to perform admirably and continue growing even in a recession. Forecasts are for 5.9% annualized FFO growth for the next 5 years. Fourth is National Fuel Gas Company, ticker symbol NFG. National Fuel Gas is a diversified energy company that operates in 5 business segments: exploration and production, pipeline and storage, gathering, utility, and energy marketing. The company's largest segment is exploration and production. National Fuel Gas is facing a headwind due to the spread of the coronavirus, but the pandemic has affected the natural gas market much less than the oil market. In addition, the pipeline and storage and gathering segments provide a strong buffer to earnings amid low commodity prices. Based on expected earnings per share of $3.80 for the upcoming fiscal year, NFG stock trades for a price-to-earnings ratio of 11.1 compared with a fair value estimate of 15. An expanding PE multiple could boost shareholder returns by 6.2% over the next 5 years. Combined with 2% expected EPS growth and the 4.3% dividend yield, total returns are expected to reach 12.2% per year through 2026. And finally, we have Altria Group, ticker symbol MO. Altria Group was founded by Philip Morris in 1847. Today, it is a consumer staples giant. It sells the Marlboro cigarette brand in the US and a number of other non-smokable brands, including Skoal, Copenhagen, and the St. Michel brand of wine. Altria has a 10% ownership stake in global beer giant Anheuser-Busch. On October 30th, Altria reported financial results for the 2020 third quarter. Revenue of $5.7 billion increased 5% year over year and beat analyst estimates of $140 million. Smokable volumes declined 0.2% for the quarter, much better than the 4% predicted drop. On a GAAP basis, Altria reported a loss of 51 cents per share, as the company took a non-cash pre-tax impairment charge of $2.6 billion related to its investment in Juul. It operates in a highly regulated industry, which virtually eliminates the threat of new competition in the tobacco industry. Altria enjoys strong brands across its product portfolio, including the #1 cigarette brand. As a result, it has pricing power and brand loyalty. In addition, tobacco companies enjoy low manufacturing and distribution costs thanks to economies of scale. In the meantime, Altria has a very high dividend yield of 8.6%. The payout appears secure as Altria generates huge cash flow even during recessions. The company has increased its dividend for 51 consecutive years. Altria ranks very high in terms of safety because the company has tremendous competitive advantages. In addition to the 8.4% dividend yield, as well as a small positive boost from an expanding PE multiple, total returns are expected at 14.4% per year over the next 5 years. Dividend Kings are the best and safest dividend stocks you can buy. This translates into growth, stability, reliability, and because they are dividend-paying companies, dividend income. All the essential elements to solid investments that a savvy investor would gladly take up in their investment portfolio. Investing in these companies can give an investor the power of growth appreciation along with income growth, two primary components of a solid investment strategy for the long term. Check out the links in the description to get started in creating your very own Dividend King portfolio that will keep paying you passive dividend income into 2021 and beyond. Thank you for watching this video. Please make sure to smash the like button if you enjoyed watching. It will really help out the YouTube algorithm for bringing more passive income strategy videos to the masses. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.